Hello and welcome to Wealth of Advice market update recorded on Wednesday, the 6th of August 2025. Obviously, done lots of updates this year, and there's been so much going on that's caused volatility across markets. And we're pleased to say in the last few weeks, things appear to have calmed down a bit, in so much as we're seeing good positive returns come back to clients' portfolios when we're sitting down having annual reviews with people. The numbers over a 12-month period are back to being positive again. Obviously, the tricky period of the year was when we were sitting down with clients during March and April, because Trump's tariffs really were at the worst, and markets were full of fear. And when markets are full of fear, you see a big sell-off. Thankfully, we didn't panic ourselves. We looked at the data, we looked at the economic data underneath the funds that we're investing into. And yes, there was a fear of what damage Trump's tariffs could do in the long term. Once he put a 90-day pause onto those tariff plans, markets started to recover. If we look now where we are with the tariffs, the chart that you can see on the screen shows the tariffs that Trump was proposing to charge all countries around the world, or major trading partners around the world, on April the 2nd. And just for example, the EU was told it was going to pay 20%. The latest rate that's been agreed is 15%. So not a huge reduction. But if you look at some of the other ones, Switzerland, I mentioned, they were in a bit of a quandary in the last few days because their proposed tariffs gone from 31 up to 39%. But Thailand is 36 down to 19, Taiwan 30 down to 32 down to 20, Vietnam 46 down to 20. So it's very interesting as well if we think of which big American companies will be most adversely affected by places like Taiwan, Vietnam, Thailand having these high tariffs imposed on them. Companies like, shall we say, Amazon, for instance, who will import a lot of goods from these Far East countries where a lot of stuff's manufactured, are seeing these reductions in those tariffs, which kind of contradicts what Trump was saying at the beginning. But when they've actually realised how much these tariffs could affect American companies, they have reduced them. The UK, sitting right in the middle of that chart, looks good. We got a 10% tariff outlined to us in April, and it's still standing at 10%. Keir Starmer had a meeting with Trump in Scotland last week, and again, positive things were led to believe were coming out of that from the point of view of how the UK is going to trade with the US. For those people who've followed the Brexit story since 2016, this is what the UK obviously needed to do as a result of not being in the EU. I'm not saying voting to leave or anything like that was right or wrong, but the UK has got a 10% tariff deal with the US, whereas the EU stands at 15%. And if you read stuff coming out of France over the last few weeks, the French are not happy at all with the deal that they've ended up with. They're calling it the Ursula von der Leyen deal rather than the EU deal. So Trump is really threw the chess pieces in the air, and this is where they've landed for now. I'm sure things will change over the coming weeks and months. And as I say, we just have to keep looking at it. We're now well past that 90 days. That was actually mid-July when we went past that 90-day pause period. And over the last few weeks, you've seen Trump still throw the odd mental line out to the press where he was going to charge extra tariffs to Canada. For some reason, he was going to do something different with Switzerland, I was reading the other day. So it's still out there, but overall the markets have kind of moved on. My own personal fear is what might this bring to the overall economic situation of the US, Europe, and Asia in the next 2 or 3 years, as the impact of these tariffs really affect, because ultimately it will be the end consumer who ends up paying these extra costs that the tariffs bring in. But thankfully, as you can see there from the chart on the screen, the FTSE 100 year to date is up 13.42%. The MSCI World Index is up 3.34%. And the S&P 500 is up 0.6%. It should be noted that this is in pound terms, and as we said on a previous update, the pound has strengthened against the dollar this year, so the S&P has actually performed better than that in its own currency, but when you convert it back to pound, it's not as good. But anyone looking at this would have seen over the last few weeks, the pound got up to $1.37 back at the beginning of July, certainly end of June into the beginning of July. It was up to 136, 137, and it's come down. It was 132 a couple of days ago, and it's up to 133 now. Part of the reason why the pound will weaken against the dollar is because of fears over what's going on in the UK economy. And if you look at this chart we're putting on the screen now, you can see that the UK economy did shrink in May. That's not good. Are we heading for a recession? Hopefully not. You look at the unemployment figures that came through from the UK. They weren't very positive. Unemployment in May was its highest point since 2021. This has obviously then prompted people guessing or predicting or putting bets on when the Bank of England will look to cut interest rates again. And the Governor of the Bank of England, Mr. Bailey, has said they will be looking at cutting UK interest rates if job losses continue to rise. But the UK has got this very fine balancing act, because if you start cutting interest rates too aggressively, then you can bring back inflation. And obviously, everyone who's experienced inflation over the last 2 or 3 years knows that we don't want that to return. So the Bank of England have definitely got a tricky job on. But you look at those unemployment numbers going up, and that's not good. Rachel Reeves has got a very, very difficult job on her hands. As I was driving in the office this morning, the latest news headline is how she's going to square up a £41 billion black hole. And that's another reason, as I say, why the pound is going to weaken against other currencies around the world, because there's so much uncertainty around what is happening with the UK economic data. The next chart that we're showing on the screen now to demonstrate again what's going on in the UK economy is from the Institute of Directors, and it shows that economic confidence in the UK is really at an all-time low. This chart looks back over 10 years. So more than 80% of business leaders polled by this lobby group in July said they were very or quite pessimistic about what the outlook was for the UK over the next year. So across in America, similar economic data is coming through, which is not positive. The US jobs growth figures for the last 3 months were the worst since the pandemic. As a result, Donald Trump decided to sack the lady whose job from the Bureau of Labour Statistics on Friday as a result of him not liking these figures. He confirmed that in a news interview he gave, that he didn't like the figures, so he got rid of the lady. That's not good really for long-term credibility of numbers coming out of a government, that the president can just sack a lady when he doesn't like the numbers. But we have to obviously appreciate that both in the UK and the US, there's lots of economic headwinds which have come over the last couple of years, rising taxes, rising interest rates, which has put a lot of employers off employing new people. So it's no real surprise, if you like, that these figures are coming out like this. On the flip side, the positive aspect of it may be that the reason why the job figures aren't looking so good is because artificial intelligence is really now coming through, and the technology benefits that certain companies are getting can be attributed to not needing to take on any new members of staff. Maybe that might be one reason. And I am linking this up with the fact that when we look at what the US growth figures have been like from their stock market's point of view, the next chart we show now shows how Meta and Microsoft shares have done very well in recent weeks, and that's as a result of the boost from artificial intelligence that these companies, these big tech companies, are showing in their recent earnings. So whilst there is negative news on one side of it, the other positive side is that these big technology companies are doing very well again. And if you look at most client portfolios, there is a bigger exposure to the US stock market, because this is where all of these companies rest. So even if you think for those clients who invested with Royal London a few years ago, the Royal London fund manager was very UK focused. If you look at the percentage that he's put in the US now, it's higher than it's ever been. The wealth of advice model portfolios has more in the US. And this is as a result to try and get access to these huge companies. Microsoft and Meta, which is Facebook, obviously, added more than $350 billion of stock market value recently after they both reported double-digit increases in revenue and net income. Microsoft became the second company to reach a $4 trillion market capitalization. That's after Nvidia did it a few months ago, and Meta, Facebook, they are 11% shy of $2 trillion. So if you think of the actual sheer value of these companies, it's absolutely huge. Again, 10, 20, 30 years' time, people looking at this era might say, well, that wasn't right, that these huge companies got so big. But that's the world that we're living in. So whilst we might not like some of Donald Trump's politics and the craziness that goes on with the tariffs, etc., you simply have to invest in these companies to try and generate long-term returns. So now, as we come to the end of another market update, let's focus on the long-term positives. Let's have a look at what the S&P 500, for example, has done over the last 5 years, 98.95%. Again, do we look at that last little bit where there was the dip? Obviously, your eyes will go to that, but what I'm looking at there is 98% growth over a 5-year period. MSCI World Index up 86%, FTSE 100 up 84.89% over a 5-year period. Yes, that goes back to August 2020 when COVID was at its height, and we have had a good run since then. There are clients who would have invested at the end of 2021 when things hit a high and then fell during 2022, and 2022 was an awful year. no getting away from that. But what these charts show you here, that if you invest in stock markets over the long run, you will be rewarded with good returns. Now, when you look at that over a 12-month period, yes, the Trump tariffs do look quite severe on there. But again, FTSE 100 up 13.5%, MSCI World Index 11.83%, and the S&P up 11.5% over that period of time. Yes, it's choppy. Yes, it's tumultuous. But for those clients invested, taking withdrawals out of a long-term plan, I do believe everyone who we speak to when we do our client reviews and do updates with them are invested in the portfolios that are suitable for them. We always ask that, do you think you're happy with the attitude of risk? Is this portfolio suitable? And that's the whole purposes of an annual review with your advisor, is to make sure that you're on the right track and you're hopefully going to get the best outcomes over the long run. So thanks again for listening to another Wealth of Advice market update. As ever, if you have any questions or queries, please don't hesitate to get in touch.